Hi guys, keep watching KS tutorials. They are the best.
Guys, keep watching KS tutorials. They are the best. Thank you for choosing KS tutorials. Thank you for having me here. On today's episode, we are going to continue from where we stopped. The other day we did IAS 1. Today we are going to talk about IAS 2. That is inventory. Inventory, valuation of inventory. So IAS 2. Talk about inventory, what do we mean? When we talk about stock, what do we mean? So inventory are materials that a company holds for sale. Let's say they hold a material for sale. Do we get it? Okay. So inventory are assets that are held for sale within 12 months. Within 12 months of business operation. So we know as a business, according to IAS 1, reporting is supposed to be done in 12 months. So in that 12 months, any asset that we hold still within that 12 months is an inventory to the business. Is an inventory to the business, or raw materials that we use in production is also inventory. So the raw materials we have for production is an inventory, or the assets that we have that we are holding to sell in the course of business within 12 months is also an inventory. Do we get it? So that is inventory. When we talk about inventory, that is all assets we are holding to sell within 12 months, or the raw materials we use for production. Do we get it? Okay. So now, since we know what an inventory is, now if you want to value, you want to have a cost for inventory in our books, how are we going to value it? That's what we are going to talk about today, how we are going to value our inventory. So to value our inventory, we need two things. We need two things. One, we need the cost, and then we need the net realizable value. So when we talk about the cost is how much you bought the asset. Any additional cost we incur in bringing the asset to its current state. So let's say we import a product, a raw material. So importation cost, the amount we bought the raw material is one. The duties we are going to pay in clearing the goods is another one. The transportation from the port or from wherever the goods were produced or the raw materials were produced to your current state or the current location is also supposed to be captured as part of the cost. And any additional cost, so we have labor cost, which is also supposed to be captured as part of the cost. We have, let's say, if we have fixed assets, you need to apportion it to the material that we are selling. Do we get it? So let's say we have electricity, and then we need to apportion the electricity to the number of consumption that material used before it became a finished goods that we are going to sell. Do we get it? So all this cost comes here to form the total cost. Then when we talk about the net realizable value, let's say if today we are not selling the product, let's say if today we are not using the product and we want to sell it, how much are we going to sell it? So how much you are going to sell it? We less our discounts, trade discount. So how much you are going to sell it less trade discount? Do we get it? We less our trade discount. Okay, and then we less our distribution cost. That will give us our net realizable value. So when we take the cost, so purchases plus, let's say, direct expenses, and then what? So all this one, the duties and everything, they are all direct expenses. So your purchases plus your direct expenses, labor, direct labor, you get it. Okay. And then when we talk about the net realizable value, we have the selling price. When you go to the market, how much you are selling it. Then we less our discount, trade discount. We less trade discount, TD, trade discount. And then we less our cost of production, and then we less our cost of selling. So let's say if you want to use the net realizable value, we check the selling price, how much we will sell it or how much it is selling at the moment in the market. And then we less our trade discount, we less our cost of production, and then we less our cost of selling. Do you get it? That will give us our net realizable value. And then that is what we are going to use in valuing the inventory. Do we get it? Okay. So what is the standard saying about the valuation of inventory? So the standard is saying that we value inventory as the lower of cost and net realizable value, NRV. So when we have the cost, the total cost for this, and then we have the net realizable value for this, we compare the two. The one that is low, that is what we use as our inventory amount in our books. Do we get it? So we don't use just the cost. We compare the cost to if we are going to sell it, how much we are going to get. How much we are going to get. And then we compare it to our cost. Which one is lower? We keep it in our books. That's what the standard is saying. That's exactly what it's very simple. So let's take a question on IAS2 inventory. All right, so it says LBC manufactures talkative recorder which trade under the name talkative. In the year ended 31st December 2018, 10,000 talkatives were manufactured and the related costs were so material cost, labor cost, depreciation of machinery, factory rate, sundry factory expenses, selling expenses, and then expenses at head office. So these are the expenses. In addition to the information above, at 31st December 2018, there were 1,000 talkatives in inventory, assuming that these have a resale value of 4,000 for a resale value of 4 Ghana cedis and a net realizable value of 1.2 each. What value should be placed on the closing inventory? What value should be placed on the closing inventory? All right, so it says the company LBC Limited. So LBC, they produced talkatives, and in the year they produced 10,000 talkatives, but 1,000 were in stock at the end of the period. 1,000 were in stock, so which means they sold 9,000. Yes, they sold 9,000 talkatives. All right. So now we need to find the cost. We need to find the cost and then we compare to the net realizable value. We need to find the cost and then compare to net realizable value. So we have some cost that cannot be classified. You cannot add it to cost, and then we have some that can be added to cost. So cost computation. All right. So we have material. Material is supposed to be part. Material is supposed to be part. So now I want to find the cost. Material is supposed to be part, which is 3,000. Let me put my Ghana cedis here. Material is 3,000. We have labor. Labor is 4,000. It's also that is supposed to be part because it's directly attributable to the product. So that's 4,000. We have depreciation of machinery. Depreciation of machinery is supposed to be part because the machinery is used directly for the product. So depreciation of machinery is also supposed to be part. That is 2,000 Ghana cedis. And then we have factory rates. Factory rates also supposed to be part because it is directly attributable to the material. So factory rate is, we have 1,000. Factory rate is 1,000. And then the next one is what? Sundry factory expenses. Sundry factory expenses. So sundry factory expenses is also supposed to be part because the expenses is for the factory. So sundry factory expenses. How much are we talking about? That's 3,000 Ghana cedis. And then the next one is selling expenses. Selling expenses here cannot be added to the cost because that is an expense which was incurred after we have produced, but we are calculating for expenses that we incurred before production. And then the next one is expenses at head office, which is administrative expenses. They are also not directly attributable to the product. So those expenses cannot be added to the cost. Do we get it? So now we have our cost here. We have our cost here. So let's add 3 plus 4, 7, 9, 10, 13. We have 13,000 as our cost. 13,000 as our cost. And then we said we produce 10,000 units. So if you want to find the units per cost, or cost per unit, it will be 13,000 divided by 10,000. This is going to give us 1.3. Do we get it? It is giving us 1.3. So now we said to value inventory, it is the lower of cost and net realizable value. Lower of cost and net realizable value. And then in the question gave us selling price and then net realizable value. The selling price was 4. But we use the net realizable value because the net realizable value has the element of cost of selling, in the sense that we have discounts and those things, everything factored in. So we use the net realizable value, which is 1.2. So the NRV is equal to 1.2, which was given in the question. Now, if we are going by the lower of cost and net realizable value, then it means we are going to select this 1.2 as our cost, or what you are going to use to value our closing stock. And then our closing stock here is 1,000 units. So meaning we multiply the 1.2 by 1,000 units. Then we will get 1,200 Ghana cedis as our cost of inventory. 1,200 cedis as our cost of inventory. Do we get it? This is very, very simple. So in case there's any challenging question on IAS 2, and then you are finding difficulty to solve it, I have my number below. You can reach out to me, or you can state the question in the comment section, and then I will gladly give you the solution or the answer to it. Don't hesitate to contact me for business. I am available for any tutorials, private class, and everything. My number is under. You can reach out to me, and then we'll have a discussion. Thank you for listening to KS Tutorials. Thank you for subscribing. Thank you for liking. Thank you for listening to me. My name is Mr. Sam. Thank you for listening to KS Tutorials. KS Tutorials, keep calm. KS Tutorials, balance on.